Welcome back. With the GDP growth rate in at 1.95%, down from the fourth quarter, and the MPC meeting for the second time in the year. Let's get some perspective from an investment analyst point of view. I'm being joined by an investment analyst with Afrinvest Securities, Omotola Abimbola. Hello, Omotola. Good morning. Thank you very much for joining us. Well, you were coming in just as the NBS was releasing the first quarter GDP, 1.95%. Was that in line with your expectations?
No, it wasn't. I would say that it was an underwhelming performance. The economy grew 1.95% in Q1, which was even lower than 2.11% recorded for Q4 2017, although the Q4 numbers were they were increased by the MBS. However, the Q1 number was significantly below the consensus estimate of 2.6%. And also, beyond the fact that the growth number was disappointing, another disappointing aspect of the data is that unlike Q4 2017, when we saw a broad-based expansion across sectors of the economy, including agri, industry, and services, this time around we had only two sectors that improved in the quarter, while the services sector relapsed into a negative growth again. And the services sector is a major sector in the economy. It contributes over 50% to GDP, and the second biggest employer of labor after agricultural sector. So in terms of both the pace of the growth and also the composition of the growth, I think it was a disappointing performance, and it was probably affected by the slower than expected growth we saw in the agri sector. Agri grew by 3% year on year. It was slower than 4.25% or thereabouts that was recorded in Q4 2017. Industry grew in line with estimates because we still have a low base impact for the oil and gas sector, which is pushing industry sector growth upward. However, the services sector, like I mentioned initially, disappointed significantly. It recorded a negative growth compared to an expansion in Q4. So all these three factors led to the underwhelming performance of the number in Q1 2018.
Now, do you think that the delayed budget may have contributed to these disappointing numbers?
Perhaps so, because fiscal policy is very major in the economy. However, when you look at the fact that we had no budget doesn't mean that the government isn't spending. We've been seeing government spending, both recurrence and capital expenditure. The 2017 budget was just closed about a week or two ago. So despite that we had no budget for 2018 doesn't mean that the fiscal policy wasn't working. In fact, we've been seeing government has been paying its dues regarding the recurrence budget and capital expenditure. Although we haven't seen a budget passage, government has used 2017 budget passed by the National Assembly to continue making capex investments in the economy. So I wouldn't say the budget was a major drag to the GDP numbers. And also the fact that government expenditure is barely 6% of GDP. Nigeria's economy is more driven by private sector spending and investment spending. And the fact that we had a negative GDP growth shows that consumer appetite, consumer confidence is still very weak. And we need to see much more traction on that before we can return to pre-crisis level of growth.
Yeah. So how do you think these negative numbers that we have seen coming will affect the market, or how do you think the market will react to that?
I think for the equity market, no doubt, growth is a very important component of earnings growth. When we are seeing fast growth in the economy, we tend to see higher sales or turnover for companies listed on the NSA. So the fact that we had a lesser than expected growth in the economy in Q1 would have a negative sentiment on the markets. But be that as it may, I think for now the equity market is more driven by investor sentiments regarding foreign portfolio flows in the economy right now than the GDP numbers. So we shouldn't see any knee-jerk reaction in the markets, at least.
Okay. So the MPC is currently a meeting. I guess they've started their meeting, and which
Indeed.
of course will end tomorrow. So how do you think this GDP number is going to affect their decision-making in this decision meeting?
Well, for monetary policy, I think the key thing for them to note is that although we are seeing growth back in the economy, the growth rate we are recording is still far below population growth rate of 2.7%. So that means that income per capita for Nigerians is still shrinking despite the recovery from the recession. And it also points to the fact that the recovery we are seeing in the economy is still very slow and very fragile. But for monetary policy in Nigeria, their major policy anchor is exchange rate stability and inflation rates, not growth, because we tend to operate a pro-cyclical monetary policy in Nigeria. So maybe not so much, we wouldn't see them react to, because if they want to react to this GDP data, the rational thing for them to do would be to ease monetary policy further so they can provide an accommodative environment for more private sector credit growth. But in Nigeria, and even you would notice that treasury rates, the risk in the fixed income market has been moderating since last year, partly due to the lower supply of government securities in the market and also the CBN's deliberate policy of getting down rates in the homo markets. But despite the lower market interest rates, we haven't seen so much of traction in private sector credit growth. Monetary gains data as of April 2018 show that private sector credit growth actually shrunk from December 2017, where broad money supply grew by less than 2%. So for monetary policy right now, I think they also need to recognize the fact that even though the major policy anchor is FX market stability and inflation and price stability, there is still a need for them to provide an accommodative environment to at least support growth in the economy back to pre-crisis level.
Well, I will come to that. How you think they are going to achieve this? Now, I spoke to Mr. Rwani earlier on the show, and he's of the view that this is the time for the monetary policy to actually ease the rate, to give room for businesses, to have access to credit. So don't you think he's in the right direction here? For us, we also believe that in terms of whether it is appropriate to cut benchmark interest rates now, we think it is appropriate, given the fact that the MPC's major policy anchor, price stability, we have seen inflation rates moderate significantly since the beginning of 2017. Inflation rate is now at 12.5%, so that makes the real interest rate using the nominal MPR as a benchmark to be at 1.5%. So in terms of price stability, there is enough justification for the MPC to cut interest rates. However, the CBN governor has persistently mentioned, and even by their actions itself, that the stability of the FX market is very paramount, is the prime monetary policy objective right now. And as you would know, in the past 2-3 weeks, we've been seeing pressures a lot in a number of emerging market economies due to the rising US dollars, as well as rising bond yields in the United States. Over the past couple of months, economic data in the US has shown persistent improvements in fundamentals there. The retail sales data has been on the uptrend. Same thing for the consumer price index data, which has shown that inflation rates in the US right now is now above the 2% target for the US Fed. So it has increased the expectation for further rate hikes by the US Fed. And as a result of that, we've seen some capital flow reversal pressures for a number of emerging markets. So it would appear a bit, it will send the wrong signal to the markets if Nigeria's monetary policy committee is slashing benchmark interest rates at a time when its peers in the emerging markets region are actually increasing theirs. And as we know, money goes where the yields are. So if yields are higher in your country, you tend to attract much more portfolio capital flows. And as you saw what happened in the markets in the last 2 weeks, the CBN has been aggressively mopping up liquidity in the financial system to prevent FX volatility in the markets. At the point in time, they mopped up nearly 600 billion naira of liquidity to prevent that. So for them to be sterilizing liquidity aggressively in 1 week and then turning around in the following weeks to cut benchmark interest rates, it would seem a bit inconsistent. So we expect the MPC to actually retain our policy rate at this meeting. Okay, so what external risk factor do you think this committee will consider in reaching a consensus? Yes, you've mentioned quite a number of them.
I think the prime external sector risk that they're looking at right now is regarding the capital flow reversal pressures from a number of emerging markets. Although on the positive side, we have seen increases in oil prices. The Brent crude touched a 4-year high nearly 4-year high of about $80 per barrel last week, driven by the renewal of sanctions by the United States on Iran, as well as the subsisting impacts of the production cost agreement by OPEC members, which has shrunk inventory level in the U.S. So although there is a positive driver for external sector stability in terms of the rising oil prices, the fact that we're in a very volatile, or should I call it a risk-off emerging markets investment environment currently, would make it a basis appropriate for the MPC to start cutting benchmark interest rates. Although there's a very good argument that although the benchmark has been at 14%, market rates has moved far above or far below the benchmark in terms of pricing and inflation expectation. Currently, the 12 months bills at the market auction, at the PMA auction, is less than 12%. So then the benchmark interest is still at 14%. So there's really enough incentive for the central bank to begin to narrow the spread between market rates and the benchmark interest rates. But considering the fact that cutting benchmark rates in this environment will send a wrong signal to the financial markets, both local and foreign investors, we think that on that basis, the CBN would probably retain our policy rate at current level.
Now, if I may ask, what in your opinion will be the trigger for this much expected rate cut?
I think the trigger would be when we start seeing foreign direct investment being a driver of foreign portfolio, of capital importation into the country. Currently, if you study the last 4 or 5 quarters of capital importation data, right from when we introduced the high and hill window, the major driver of capital inflows into the country is foreign portfolio investments. And where are they going to? They're going to short-term investment opportunities, money markets, securities, and they're going to the fixed income market, the bond markets as well. And these are hot money. Anytime there is any trace of instability in emerging markets, when we are seeing development in monetary policy in advanced economies, we tend to see a reversal in these flows, which can cause volatility in the fixed income market, which the central bank is very particular about, because fixed income, because the FX rate is a major driver of inflation as well, price stability, which is their second major monetary policy anchor. So for them, they would like to see investor sentiments fully back in terms of FDI influence into the economy, and they also like to see greater policy stability, because currently foreign investors are pricing in the anticipated volatility in the economy as we approach the election. The pricing is the securities pricing, which is why you will see that the flows, the capital flows in the last capital importation data that came out, we saw a rebalancing of foreign investors' exposure from the equity market, which is more risky, to more short-term money market securities. So all these risks, the CBN would like to see them substantially reduced before they take the initiative and then start cutting the benchmark interest rates.
Now, in all of this, where does the fiscal policy play a role?
Fiscal policy is very important because a number of reforms necessary to allow for a fully functional and market pricing of FX rates in the economy depends on fiscal policy action. One of them is the downstream oil and gas sector, and even the power sector. Like I mentioned before, the CBN would like to see FDI coming back into the economy. But for indirect investment, it is dependent on the available long-term opportunities in the economy. And long-term opportunities in the economy are created by structural reforms. Structural reforms are driven by fiscal policy actions. So for the MPC or for the central bank, they would like to see much more deeper commitments to structural reforms by the federal governments. And that includes looking at the downstream oil and gas sector, looking at the power sector, looking at the fiscal viability of some national governments. Right now, as of today, many of the state governments are very close to insolvency. So they would like to see, greater stability in financing for the subnational entities, so as to improve the long-term growth prospect of the economy.
All right, thank you very much for your time, Omotola. Omotola Abimbola is one of the investment analysts at Afrinvest Securities. Well, we'll take a quick break now. When we come back, we'll look at the agricultural sector. Just stay with us.